Sharp price swings on the spot market, higher electricity demand across Europe, impact on the energy market of renewed peace talks concerning the war in Ukraine. Hello, my name is Bartek and I welcome to the Energy Market Overview. November PMI data confirm a clear slowdown in global manufacturing, with most major economies remaining below 50 points, signaling a shrinking industrial sector. As for the energy market, November brought us a classic winter pattern of a volatile wind generation. Europe moved from strong periods of high output to almost windless days, and this was immediately reflected in spot prices, both in Poland and Germany. In Poland, spot prices ranged from 294 zloty up to 991 zloty per megawatt hour. In Germany, from 56 euro to more than 280 euro per megawatt hour. In France, from 20 euro to 112 euro per megawatt hour. On top of that, the seasonal decline in solar generation meant PV had a marginal impact on prices throughout the month. Unlike the spot market, forward contracts in Poland increased steadily and gradually in November, which, from the consumer's perspective, is certainly not what we would like to see. Poland, for the delivery in 2026, we saw prices in the range 440 up to 454 zloty per megawatt hour. In terms of 2027 delivery, from 439 up to 450 zloty per megawatt hour. By the way, the monthly average spot price in Poland was very high in November. It was at the level of 524, and only February noted a higher value this year at 562 zloty per megawatt hour. In terms of Germany, both the annual contract and the Q1 delivery showed stronger price dynamics, followed by a slight decline toward the end of the month. In terms of France, forward prices fell to their lowest levels in 5 years, even down to around 50 euro per megawatt hour for 2026 delivery. And contrary to what we saw between 2020 and 2023, the availability of French nuclear units this year has been very strong. Only 15% of capacity was offline, the highest availability in the past 5 years. And France remains a net exporter, supporting Germany, Italy, and Belgium. Why are Polish forwards rising? Well, two key reasons. The first one, there is a high CO2 price and strong long positions from investment funds. CO2 broke above 80 euro per ton, and the market began pricing in a possible move towards 90 euro per ton in early 2026. ICIS even points to the possibility of prices reaching 100 euro per ton by spring 2026. Well, let's hope, as it often is the case, that such forecasts do not materialize fully. The rise in CO2 translated immediately into higher forward prices, especially in Poland. Funds continue to hold large long positions, anticipating higher CO2 prices in 2026. Weaker renewable generation, that's the second aspect, why the Polish electricity forward prices are moving up. Well, especially wind. Wind generation in November was significantly lower compared to October. With higher demand across Europe, this naturally pushed forward prices upwards. In terms of gas, gas was the calmest segment of the energy complex. TTF, Dutch TTF 2026, fell below 30 euro per megawatt hour. In Poland, the downward trend continued. Q1 traded around 145 zloty, and 2027 delivery was below 140 zloty per megawatt hour. Demand for gas in Europe was higher due to a cold snap, but in most European countries, the situation is similar to the same period last year. As for Asia, China year-to-date imports down 14% versus 2024. Japan, Korea stable. India, after a period of higher purchases, now there is a minus 6% year-to-date versus last year. On the supply side, conditions remain very strong. First, Europe holds about 76% of the storage fullness, lower than in 2022 and 2024, but higher than during the crisis year 2021. It is worth mentioning that we have record LNG flows from the United States. There is a stable gas pipeline deliveries from Norway, the absence of cold weather forecasts at the start of December, and new global LNG capacity is scheduled to come online in 2026, 2027. With regards to oil and coal, a couple of words. The Brent crude ended November in the $60 to $63 per barrel range, moving sideways. OPEC Plus maintained its current production policy. Coal, EPI second, rebounded at the end of the month after earlier declines, trading again around $9,802 per ton. The market remains well supplied. In November, we also saw another round of peace discussions between the US, Ukraine, and Russia. This does not determine any political outcome, of course, but the energy market reacted exactly as expected. Oil stabilized in a sideways trend as the market began pricing in the possibility of greater future supply of Russian crude. Gas maintained a very soft downward trend, reflecting a lower geopolitical and infrastructure risk premium. And the most countries upward pressure on power forwards east as geopolitics no longer added fuel to the fire. This is important as this time of the year, geopolitical tension typically pushes prices higher. This year, we saw the opposite. Okay, so what does this mean for companies? Price volatility in electricity will stay with us throughout the winter. As I mentioned in my previous video a couple of weeks ago, a few windless days are enough for spot prices to spike again. Electricity prices, forward prices, still have room for gradual increases. As for gas, gas remains the stabilizing force, but European and Asian demand as well as weather remain crucial. French nuclear availability is at its best in years, boosting the stability of the entire European system. And CO2. CO2 remains the key directional driver. That's all for today. Thank you very much for watching this. If you found this material valuable, it would be great if you leave a comment or share it on LinkedIn. Additionally, we have our new YouTube channel where we will be publishing interesting energy procurement materials. So thank you again and take care.